For more on Dimon's takeaways on the Fed and the economy, let's bring in our panel. We are joined now by Nick Timiraos, who is the Wall Street Journal Chief Economics Correspondent, and we've got Claudia Sahm, Sahm Consulting founder and former Federal Reserve Board Economist. Great to have you both here with us. As we're kind of continuing to let some of those thoughts ring through our minds of what Jamie Dimon had to say there. Nick, I want to go to you first just on what this sets up for a Fed that we just heard of and ultimately how the banks are thinking about the Fed's positioning and the way forward from here.
Well, I think what we heard yesterday is that the Fed is still in inflation fighting mode, but Powell seems more confident that they can fight inflation without having to raise interest rates further, and instead just by holding rates steady. And so that's a change from maybe a few months ago. I think he knows how to signal a plan to hike again, and he declined several opportunities to do that on Wednesday, including at times I thought he was distancing himself from the dot plot, the summary of economic projections in September, where a majority of officials had projected one more rate increase this year. Of course, because of the calendar, we know that would have to be in December. And he didn't really, point back to it. So one interpretation, you could say he was keeping his options on the table, wasn't ruling anything out. That's certainly true. But some of the body language, his read on the economy suggested he doesn't want to hike again if he can, if the data can support that.
Claudia, I want to bring you in here and ask this question to you. What's your take on Dimon's interpretation of the impact of where the Fed is in its rate hiking cycle? What's your assessment?
So I absolutely agree with Dimon that everything's on the table. Anything could happen. The Fed has said numerous times that they're in a risk management mode and also pointed to geopolitical risks, new risks that could show up along the horizon. I do think that they're having a real impact even out at the long end, the 10-year treasuries. The Fed really is looked to as the oracle. Like, let's interpret the data. And I agree with Nick that they have taken a much more sanguine approach that they didn't have to. Inflation had kind of stuck around and wages didn't move down as much as had been expected. And yet, and GDP has been really strong. And he said, that's okay. We're gonna make progress. And so I think Jay Powell's message was more optimistic than Dimon's. And I think given what we know right now, that's appropriate. And yet, yes, we should have prepared for the risks.
Claudia, what do you make of the assessments just about recession at this point in time, and for Jamie Dimon and what they're seeing, not just in how the Fed is conducting its own policy, but also in the customers that they service, and really pointing back to the resiliency of the consumer right now?
I think we need to recognize the fact that we are leaving 2023 in a much better place than most commentators and probably even the Fed thought we would. Consumer spending has held up. Yes, their wealth has increased. People have built a buffer. It's not just the fiscal stimulus at this point. Like, they have set some money aside, and that's really important. And most of all, the labor market has continued to be very strong, even as it's moderated some. And that is absolutely crucial to spending and growth going forward. And so far, it's been a rebalancing that has been gradual, slow and steady. And that is the exact opposite of a recession. You could still have one. There are a lot of bad things that could happen. But so far, we are moving in the right direction. I know Nick yesterday really pushed Powell on the recession. Is it in your forecast? And, he said, no, not in the staff forecast.
Nick, I want to ask you then, what's your assessment of when you think about how Dimon came across as more, I wouldn't call him he used the term of they stress test, basically. They test for these scenarios of higher rates, right? And we're not at 1982 levels, right? Is Dimon too worried, or is Powell too optimistic? What's your take?
Well, they have different jobs, right? And Dimon's job is to make sure the bank is positioned for any environment. And I think it's reasonable to highlight the tail risk that, if you pause here and you pause again in December, of course, there is a risk that if the economy is stronger, and it has been stronger than people have expected for 18 months now. And if that continues, I think the risk here is, yes, you aren't talking about doing one more rate increase in the first half of 2024. You're talking about doing, maybe more than one. And so that's the risk. At the same time, Dimon said, in that interview, he would be pausing here. I would go back to something Claudia said. I think the tell yesterday was in how Powell characterized the data. He had opportunities to point to, the University of Michigan inflation expectations number, which was high last month. He dismissed it, not a big deal. He said inflation expectations are moving in the right direction. Stronger consumer spending and hiring, not a problem because we're getting a supply side lift. And so, I thought it was interesting that he just placed more emphasis on the glass half full interpretation of the recent data rather than the glass half empty.
Oh, great characterization there. We'll have to bookmark our conversation, but I want to send our thanks to Nick Timiraos, Wall Street Journal Chief Economics Correspondent, and Claudia Sahm, Consulting founder, former Federal Reserve Board Economist. Thanks to both of you.